times the quote was the exact same price and size. It was just repeated over and over and over again. So it was not adding any value. It was not improving the BBO at the time. And a lot of times the quotes were even way outside the BBO. For example, if a stock was trading at $5, you might get a bid at $2 and an ask at 10. So it's way outside the NBBO, so it's not improving, no value, it's just noise. And this was a term that Eric came up with called quote stuffing. Why do people do quote stuffing? Well, it can cause dislocation. It can add another opportunity to cause other systems to slow down. And then the firms that do that look for different arbitrage opportunities. Can they buy on one exchange and sell on another? Can they trade the E-minis versus the SPY based on that? And it can confuse the different algorithms out there. People spend a lot of time and money building different algorithms out there. They're looking for different ways to game the system and get an advantage off other people. One of the ways that people combat this is with quote stuffing. They'll put different quotes out there to confuse smart order routers, to confuse other algorithms, to get an advantage. There's what some people refer to as exchange gateway latencies. They will look at the speed that they can get an order executed on one exchange versus the speed of another. And then they will look for that difference. So if it takes them 2 milliseconds to get executed on one exchange and 3 milliseconds on another exchange, then they will know that, and they will be pausing, checking that throughout the day because it won't be consistent. So they'll be sending out quotes to see what the latency is from, say, ARCA versus NASDAQ or BATS.
Hey, Jerry,
orders based on that.
I've got a question.
Yeah.
Sorry about that. I have a question for you, Jerry. Sure. Do you find quote stuffing, I mean, is this pretty much just happening on equities? Because what about the exchange messaging limits? You know, does that apply to futures only, or is that for equities too?
Well, when the order is sent to the market center, they have different ports, and there's a limit that they can send on that port. But then what some of the firms will do is just have multiple ports, so they can blast out those quotes.
So isn't there? This is outside of my realm of expertise, but I thought that there was some type of a messaging limit that said for every X number of quotes that you transmit, you have to execute one order. You know, you have to get filled.
Yeah, that's fairly new. It doesn't stop you, but it's just a fee that they're starting to charge. And I'll go over that. ICE is doing that. NASDAQ's going to be rolling that out here shortly. So they've got different ratios from the traded quote ratios, but that doesn't apply for everybody on all exchanges.
So, I mean, is that specifically trying to target the quote stuffing? I'm wondering. Well, first of all, can you clarify for me? Is quote stuffing happening with futures, or is it pretty much just equities?
No, across the board.
Okay. And do these new messaging
especially
limits,
on the options markets too? Yeah.
Okay. And do these new messaging limits apply to everything, or is it just futures?
It's an exchange by exchange level basis.
Okay. So you said that there's just a fee. Do you happen to know, I mean, is this fee a real deterrent to stop, or is this like a, whatever, that's not really, okay.
No, it's not. In fact, depending on which exchange, some of them even have waivers for some firms.
Oh, okay. Well, that must be nice.
So it doesn't even apply to everybody.
And speaking of these golden firms, the original report by the SEC on the flash crash, right? I mean, they know who that 75,000 contract order came from because they could see that extra bit of data that, of course, no one else can see. But did they ever release that information? Was it ever made public?
It was not officially, but we've talked to the firm who it was, and that's how we got their trade information on that graph earlier that showed that.
Oh, okay.
That's how we knew that their trades were. And in fact, they ran the same order on different days, and it did not cause a flash crash.
So basically, the SEC was completely wrong, and they're just not willing to admit it. Or is it possible, or is it practical, or probable? I mean, that they really have no idea what happened.
Well, there was a lot of moving pieces and a lot of data, and they were under pressure to point the finger at somebody.
Right. But I mean, without actually, I'm just, we have all these limits, right, of how much the market can move up or down. Is that really the only safeguard that there is? Is that this has happened since May 2010. It happened several months ago in crude. There was some rogue algo that sent crude, off a cliff, and they halted trading for a little bit. Is that pretty
Get your
much the
iced
only thing we
tea,
can count on these days? is
settle
halt
up,
trading?
that
and
has-
listen to
that
the
has
business.
worked quite a bit. In fact, even on the flash crash when the CME halted trading,
Take
that
notes.
caused people to take a step back, look at things, and then the market was more orderly.
This is the only
recovered.
pen you should ever buy.
And that's one thing that the equity markets are starting to do now too. Is do that pause where it seemed to work pretty good on the CME, and then NYMEX as well too.
Okay, and I see Eric saying he's got a story. So Eric, if you want, your mic's on.
Well, I don't want to take up too much time, but we were kind of in the middle of the whole analysis of Waddell and Reed and what the SEC knew and what they didn't know. They wanted to share it, but they didn't want to share it. Waddell and Reed gave us all their trade executions, which is approximately 6,500 or so executions that made up 75,000 contracts. And as Jerry mentioned, that is how the plot of data comes from. Their actual trade executions. We matched them up to the CME time and sales from our data set, matched time, price, and size. They all matched up perfectly. One of the first things we found is all the trades that executed at the offer. So it never crossed the bid-ask spread. It never actually hit the bid zone, which was quite surprising because if you read the SEC report, it's pretty clear that their algorithm is supposedly aggressive. But selling at the offer side is not aggressive.
Right. So how
nobody,
it can't move it down, right?
you can't push a market down by sitting on the offer side. If nobody ever hit the bid, they would have never been able to sell all their contracts at the end of the day. What was most fascinating about the whole event was Waddell & Reed uses Barclays to execute the algorithm. Waddell & Reed is mostly a mutual fund, and one of the funds that sold these contracts did it to kind of boost their returns by a few percentage points. They don't actively trade the earnings, they just use it to hedge against their position. So they use Barclays, and they've used them in the past to do this, and they're well aware of the different algorithms and the impact of the market. And so Barclays executed the contracts for Waddell & Reed, and actually led by a man there at Barclays named DJ Pan. In talking to them after we analyzed and charted a lot of the trades out, I said, so I don't understand how the SEC, when you talk to the SEC,